Share price equals entertainment until the day you sell. I think I'm going to make t-shirts after this interview with that one on there.
I think I borrowed that from Frank Slootman. I'll give him the credit for it, but it just stuck with me. Whether you're in the private markets or the public markets, your share price is a signal, but it's not ultimately liquidity. And the only price that ultimately matters is the price on the day that you transact. And in 2020 and 2021, there were a lot of companies that were chasing the next valuation in the market. It looks really, really good in a press release, and you run the risk of not meeting the expectations that you set for yourself.
It's self-inflicted sometimes.
It is, and then you can put yourself into a really tricky box that creates a ton of problems for future you.
I find that people who aren't in the finance department sometimes assume that what you raise at means that's what you could sell at. I believe those can be two very different things.
Two very different things. And it's not just what you could sell at in the public markets too. If you're selling to a strategic acquirer, don't forget they have a synergy case, and it's not what it might be worth to you or to someone else in the market. It's what it's going to be worth to them.
The more you raise, the more complex your cap table is. Walk me through that.
One thing you really want to avoid is playing games with headline valuation. Don't force a number. Don't force structure.
Change the denominator.
You need to accept, sometimes what the market's telling you. There are moments where it might be better to take a slightly lower price or maybe a little bit more dilution, but it can give you cleaner terms, give you a lot more flexibility, and going back to the controlling your own destiny point doesn't create problems for the business down the line.
So playing games, it's not worth it.
Not usually.
Just take a clean term sheet.
I much prefer sleeping better at night.